We're jumping straight into CoreWeave today. Everyone's watching the price action, but the real story is their massive revenue backlog and AI infrastructure build-out.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Before we really get into the weeds today, please make sure to subscribe and hit the like button.
Yeah.
It really helps us keep bringing you these breakdowns.
Yeah, absolutely.
Okay, let's unpack this setup because it is genuinely fascinating. We have this central paradox here that is leaving a lot of retail and institutional investors just, scratching their heads.
Oh, completely.
CoreWeave just reported staggering triple-digit growth. I mean, we are talking phenomenal top-line numbers, yet the market threw an absolute fit, causing the stock to slump over 19% right at the earnings open.
Yeah, right at the bell.
Right at the bell. So our mission today is to help you cut through all that noise, skip the panic, and understand the actual mechanics driving this extreme volatility.
It really is a tale of two different realities colliding on Wall Street right now. You look at the business operations and it looks like a rocket ship. But then you look at the chart on earnings day and it looks like a disaster. To understand why, we have to tear apart both the bull case that drove the valuation up so high in the first place and the immediate bear case that is currently dragging it back down to earth.
Let's start with those top-line numbers because they completely shattered expectations.
Yeah.
Q4 2025 revenue came in at $1.57 billion.
Which is huge.
It's massive.
Yeah.
That is 110% year-over-year growth. And that brought their full year 2025 revenue to a milestone of $5.1 billion.
Yeah, you have to stop and think about that for a second.
Right. When a company is operating in the billions, doubling revenue year over year is incredibly rare. It implies a level of scaling that most management teams simply cannot handle logistically.
No, they can't. Usually the wheels fall off the supply chain long before you hit 100% growth at that scale. And management's guidance for the future suggests they aren't slowing down at all.
Not even a little bit.
They are projecting $12 to $13 billion in revenue for 2026.
Wow.
To put that in perspective for you, the Street was modeling expectations around $9.3 billion. CoreWeave essentially told the market that the most optimistic analyst models weren't even close to the reality of the demand they're seeing on the ground.
Okay, but how does a management team confidently tell Wall Street they're going to make $3 or $4 billion more than anyone modeled?
It all comes down to the backlog.
Right. They are sitting on a $66.8 billion revenue backlog. That number is, honestly, it's almost difficult to wrap your head around.
It's staggering.
It's 4 times higher than it was at the start of the year, driven by massive commitments from heavy hitters like OpenAI and Meta.
And that backlog is the ultimate safety net. For you listening, it's critical to remember how ironclad these agreements are in the AI infrastructure space.
Yeah, clarify that because people hear backlog and they think sales pipeline.
Exactly. And we aren't talking about a soft sales pipeline or informal letters of intent. These are legally binding multi-year contracts. OpenAI and Meta are aggressively securing compute power for the next decade, and they are locking in that capacity with CoreWeave today.
Which completely changes the math.
It does. When you have a $66.8 billion contractual floor, it completely changes how you can leverage your balance sheet and finance your growth. You have guaranteed cash flow waiting for you the second you plug a server in.
Which begs a massive question. Why are OpenAI and Meta throwing tens of billions of dollars at CoreWeave?
Right.
Why aren't they just leaning on the traditional hyperscalers? AWS, Azure, Google Cloud, they have practically infinite resources. How does a specialized player build a moat deep enough to fend off trillion-dollar tech giants?
It comes down to architectural DNA.
Okay, break that down.
Well, the legacy hyperscalers were built over the last 15 years for general-purpose computing. Their data centers are optimized to host thousands of different enterprise applications, microservices, databases.
Like hosting websites and corporate software?
Exactly. They rely heavily on virtualization and standard networking so they can slice up their servers for thousands of small clients. But training a frontier AI model doesn't need general compute.
It needs raw power.
It needs massive, uninterrupted parallel processing with near-zero latency between thousands of GPUs. CoreWeave saw this bottleneck years ago. They didn't try to be AWS. Instead, they built their infrastructure entirely around bare metal, GPU-accelerated environments using InfiniBand networking.
Meaning they aren't carrying the technical debt of trying to be everything to everyone. They are just a pure-play supercomputer for artificial intelligence.
Precisely. The hyperscalers are trying to retrofit their general-purpose data centers to handle high-density AI workloads, which is kind of like trying to turn a commercial airliner into a fighter jet mid-flight.
That's a great way to put it.
Meanwhile, CoreWeave built the fighter jet from scratch. Furthermore, this architectural advantage has given them incredibly lucrative, multi-billion-dollar partnerships.
Right, the Nvidia connection.
Exactly. They're heavily aligned with Nvidia, which gives them preferential access to the newest chip allocations. Nvidia knows CoreWeave's network is optimized to make their GPUs perform at their absolute peak, so they prioritize them in the supply chain.
Okay, so they have the undisputed architectural advantage. They have preferential treatment from Nvidia, and they have a $66.8 billion safety net of locked-in contracts.
All green flags.
Looking at the flip side, why on earth did I watch the stock fall off a cliff by 19% at the opening bell?
Welcome to the CapEx tantrum.
The CapEx tantrum.
Yes. This is where the narrative sharply pivots from a software growth story to an industrial reality check.
Capital expenditures.
Exactly. In 2025, CoreWeave spent $14.9 billion on CapEx. That's already a massive figure. But the real shocker, the number that sent institutional algorithms into an absolute selling frenzy, was their 2026 projection.
Brace yourselves for this one.
They are forecasting $30 to $35 billion in CapEx for a single year.
$30 to $35 billion in 12 months.
Yep.
I mean, even with guaranteed contracts, doesn't that level of capital outflow terrify you?
It does if you don't contextualize it.
Because investors spent the last decade falling in love with cloud computing, because it offered incredibly high margins and low physical footprints. But this report forced the market to wake up and realize that AI infrastructure is heavy industry.
Very heavy industry.
It's land acquisition, thousands of tons of concrete, industrial cooling towers, and miles of high-voltage cabling.
It is absolutely terrifying if you evaluate them like a traditional tech company. When you spend $35 billion on physical infrastructure, it completely ravages your bottom line in the short term.
Which explains the EPS miss.
And that explains the massive earnings miss we saw. Wall Street expected an adjusted EPS loss of negative 61 cents. CoreWeave posted a loss of negative 89 cents.
Wait, if they beat revenue expectations by a mile, how does the EPS miss by almost 30 cents? How does the profitability disconnect so violently from the top line?
It's the brutal accounting reality of data center expansion. The expenses front-run the revenue by a wide margin.
Meaning the money leaves the building way before the new money comes in.
Exactly. When CoreWeave breaks ground on a new facility, the capital immediately starts flying out the door. You have massive labor costs, raw materials, and the procurement of the servers themselves.
The physical GPUs.
Right. And the moment those incredibly expensive GPUs are racked, they start depreciating on the balance sheet.
That's right.
Plus, you have massive power agreements that have to be paid for upfront.
So all of this hits the income statement heavily before the data center is fully online and generating a single dollar of recognized revenue from a client. So they're effectively being penalized for building too fast. The faster they build to satisfy that $66.8 billion backlog, the worse their short-term earnings are going to look.
That's the structural paradox right there.
Hey.
And building at this velocity requires a mountain of cash, which brings us to their leverage.
The debt.
The debt. Their debt-to-equity ratio is currently sitting at 2.66. Furthermore, their current ratio and quick ratio are both sitting at 0.49.
A quick ratio of 0.49.
Yeah.
If we were looking at a mature SaaS business, sub 1.0 is a glaring red flag for technical insolvency. It means you don't have the liquid assets to cover your short-term liabilities.
Right. In a traditional business, that's panic mode.
But for you watching this hyper-growth space, you know, the rules bend when there's a multi-billion-dollar backlog backing it up. The question isn't, are they broke? Right. The question is, can they roll this debt over fast enough in the capital markets?
And that is exactly why the market is pricing in so much risk. Lenders are happy to finance infrastructure when the contracts are guaranteed by Meta and Microsoft, but we are operating in an environment where interest rates are a constant threat.
They aren't cheap anymore.
No. Taking on tens of billions in debt with a 2.66 DE ratio means your execution has to be flawless. Any delay in getting a data center online means you are paying interest without the matching revenue stream. There is zero margin for error.
Which brings us to the execution hurdles that completely poured gasoline on this fire.
Right, because it wasn't just the CapEx number that spooked the street.
Look at their Q1 2026 revenue guidance. They guided for $1.9 to $2.0 billion, while analysts were expecting $2.24 billion. You can't promise $13 billion for the full year and then whiff the very first quarter out of the gate.
You really can't.
That immediately makes investors question the timeline.
The market hates a backloaded year. When a management team says, we missed Q1, but don't worry, we'll make it up in Q3 and Q4, investors inherently discount that promise.
They assume it's just hoping for a miracle.
Exactly. Add in the reports of insider selling prior to the print, and the standard flurry of securities fraud suits that inevitably get filed when a stock drops 19% in a single session.
Those always pop up like clockwork.
Always. And it creates a perfect storm of negative sentiment. The institutional money looked at the debt load, the front-loaded spending, and the Q1 guidance miss, and decided to take risk off the table.
So considering this massive tug-of-war between a golden backlog and horrifying short-term capital burn, what should you be focusing on over the next 30 to 60 days?
We have to look at the milestones.
Right. We need to outline the specific triggers for 2026, starting with the Q1 earnings report expected around May. This is going to be the ultimate proving ground.
During that May earnings call, you need to ignore the noise and laser focus on one metric: capacity delivery. Specifically, their progress toward the 850 megawatt mark for total power capacity. They are aiming to double their total power to 1.7 gigawatts by year-end.
Let's talk about the reality of 1.7 gigawatts, because I think a lot of people underestimate what a logistical nightmare that is. We aren't just talking about buying servers.
Not at all.
We are talking about negotiating with utility companies that operate on 5-year planning cycles, while CoreWeave is operating on a 6-month timeline.
The clash of two totally different worlds.
The national power grid is incredibly constrained right now. Procuring the necessary high-voltage transformers alone can take years.
That is the hidden bottleneck of the AI revolution.
Yeah.
You can have all the Nvidia chips in the world, but if you can't draw the power from the grid to run them, they're just expensive paperweights.
Exactly.
If CoreWeave hits that 850 megawatt milestone on schedule in Q1, it will send a massive signal to the market that their supply chain and utility partnerships are holding up under the strain.
And if they miss it?
If they miss that power milestone, the $13 billion revenue guidance for the year is mathematically impossible to hit.
Because they physically can't turn the servers on.
Exactly.
Beyond the internal execution metrics, you also need to watch the broader market tailwinds. We have major AI conferences coming up over the next few months.
Those are always catalysts.
Every time an OpenAI or a Meta announces a new parameter-heavy frontier model, it underscores the insatiable demand for GPU compute. It reminds the market why that $66.8 billion backlog exists in the first place.
You also need to keep a close eye on the debt markets. There have been persistent rumors about challenges with the specific debt sale CoreWeave was trying to execute.
Which would explain some of the jitteriness.
Definitely. While management has denied any structural issues, a highly leveraged company is always at the mercy of credit market sentiment.
Especially when you need $35 billion.
Right. If we see a definitive headline in the coming weeks that they successfully executed a new debt offering at favorable, non-punitive terms, it would instantly act as a massive positive catalyst.
Because it proves they can fund the dream.
It would prove the credit markets are still willing to fund the build-out, yes.
It's all about bridging the gap. They just need to survive the construction phase without diluting the equity into oblivion.
Survive to reap the rewards of the backlog.
All right, it's time for the final lowdown wrap-up. If you take one thing away from this analysis, let it be the core tension driving this entire story.
The two realities we mentioned earlier.
Exactly. We are watching a real-time battle between a painful short-term reality and a highly lucrative multi-year future. The short-term reality is aggressive, terrifying capital expenditure, tens of billions of dollars flying out the door, widening losses, and uncomfortable leverage.
It's hard to stop.
But the future reality is a $66.8 billion AI backlog guaranteed by the biggest tech companies on the planet. The market brutally punished them for the upfront cost, but the long-term thesis remains incredibly powerful if they can execute the build-out.
I want to leave you with one final lingering question to ponder on your own. It's really the crux of this entire debate.
Let's hear it.
If almost all of that terrifying $30 to $35 billion in spending planned for 2026 is actually backed by signed contracts, is Wall Street fundamentally mispricing the difference between reckless speculative spending and guaranteed future infrastructure?
That is the multi-billion-dollar question.
Right.
Thank you for joining us today. Remember to subscribe to the Easy Money Show, hit that like button, and tune in next time as we continue to simplify the market's biggest moves. Stay curious, and we'll see you then.